Fair value gaps this, fair value gaps that. I mean, we have been hearing it since forever about fair value gaps, imbalances, whatever, whatever. Now, you see, the biggest downside after learning the fair value gaps or the imbalances that, we pretty much see it everywhere on the chart. Which one that matters, we are still confused. Or there are a lot of times, you are presented with a huge ass fair value gap and you don't even know which one is the correct one. Now, I do know that a couple of them out there, they would use the 50% of the fair value gap and like whatever, whatever. No, in this video, we are going to be breaking down which imbalances or which fair value gaps matter the most. Now, do keep in mind here, guys, when I say imbalances, they're pretty much the same thing as fair value gaps. Yeah. And talking about fair value gaps, if we were to look at the basics of the fair value gap here or imbalance, the understanding of it, the core understanding of it is pretty much when you have three candles, it should have three candles, cannot be of one candle or two candles as an imbalance. Okay. It will always be of three candles. Now, what you want to focus on, this is whatever you see here on the chart here is a bullish example. 1, 2, 3, three candles. You want to focus on the wick here, guys. Okay. The wick there is the one that matters the most. If the wicks are not connecting, then again, that becomes your imbalance or your fair value gap. Okay, whatever you want to call it, it's pretty much the same thing. And for bearish scenario, it should be the same, just bearish candle. Now, does like these kind of candles, like the color of them, do they really matter? Not necessarily, guys. If let's say, for example, here for some reason this one here was a bearish candle, can we still call this as an imbalance? The answer is yes, absolutely, 100%. Right? You just want to differentiate which one is a bullish imbalance and which one is a bearish imbalance, and it should be pretty straightforward. Okay. Now you see imbalances on its own. This is something that I've seen pretty much everywhere, guys, that as soon as we learn about imbalances, we try to implement imbalances on its own, which, hear me out on this, right, guys? It's not enough. Okay, we need to combine a couple of things, okay, to make imbalances work. Now, I'm not here trying to overcomplicate things, but this is the truth here, guys, that using only imbalances wouldn't work. Now, why am I saying that is pretty much here. Live example here on the chart right now. We have learned about imbalances. It's pretty much everywhere. We do understand how to spot them. We didn't learn anything about imbalances. We learned how to spot them, right? Let's say that entire imbalance, like, don't you think that that is a bit too big? Now you have multiple imbalances here. Which one to mark? We still don't know which one is the one that matters the most. So all of this here is something that we're gonna break it down in this video. Now, make sure you guys don't skip and actually watch the entire video, because again, there will be a couple of things. I'm pretty sure even if by now you guys know what are imbalances, there's still gonna be a couple of things that is going to be completely new for you. Okay. Now, first things first, guys, let's repeat again. Imbalances on its own is not enough. If you are right now trying to implement the concept of imbalances, your first time doing it, what I recommend you doing is pretty much get into understanding that you are at a phase where you are trying to build a muscle memory of spotting your imbalances. And the way I recommend you guys doing is pretty much go on empty chart and then just mark every single imbalance that you see. And this is how it should look like, something like this. Okay, there you go. You want to mark every single imbalance, every single one of them. Do keep in mind, this is for the sake of practice. You want to be doing this. Later on, once you actually implement it into your system, you're not going to be marking all of these imbalances like this. We're not going to be doing this, but this is for the sake of practice, okay? Once you are okay with, spotting imbalances, then you can move forward on refining your imbalance. Now, you see over here, guys, let's try to understand it a bit deeper. And that is the first thing to know. Imbalances without liquidity, without efficiency is nothing, okay? You can even ignore the efficiency, but without liquidity, imbalance is nothing, and it goes vice versa. Liquidity without imbalance is nothing. Imbalance without liquidity pretty much is nothing, okay? So how do we implement this into our system then? First things first, to understand liquidity, you guys need to understand the market structure. I've made a video on market structure. Please make sure, if you guys, haven't watched it, go out there. It's pretty much there in the channel. Watch about market structure. And if you already know about market structure, don't just say, I know market structure, because just watch the video pretty much, right? Now, understanding the imbalances, right? We need to understand the other two objectives, because imbalances, they are objective, okay? If I were to write down the objectives here, when I say objective, these are the things that price chases. Number one would be the liquidity. Number two is imbalances. or fair value gaps, whatever you want to call it. Number three is going to be the efficiencies. Okay. These three are the objectives. Now, you see, let me actually point it out to you guys, right? I've been saying this, that everything is a matter of perspective. Why am I saying this? Pretty much, think about it like this, guys. Analyze every single move in the market, the big move, okay? The big expansion moves that you'll see, even a small pullback, you will notice that it will happen after these three objectives here are fully completed by the price. Okay, first time hearing it, right? I know, because most of the videos out there, they will teach you how to spot your imbalances, but they don't teach you how to implement them. Let me actually tell you guys here, to properly implement imbalances, you need to understand these two here, liquidity and efficiencies. I've made a video on these two here. There you go. Make sure you go out there and actually watch it, understand it. Now, imbalances here, if we were to mark, let's say an example, you have this huge imbalance here, okay? And then that huge imbalance, you will never know till where is the price going to make a pullback towards. If you try to take, let's say 50% of that, half of the imbalance, price never even made a pullback towards the 50% of it, right? So how do we actually deal with this then? It's actually pretty straightforward, guys. You got to implement these three here. First is going to be a liquidity. So let's try to understand that what makes this imbalance here strong is pretty much the liquidity that is sitting above that imbalance, this particular imbalance here. So liquidity comes first, then only imbalance. The first one here is the liquidity, which is again, all of that there is pretty much build up liquidity. Good. That makes this imbalance here higher probability. Second thing here that makes this imbalance here strong is pretty much efficiency. Efficiency coupled with a build up liquidity or any sort of liquidity makes this imbalance here super, super strong, right? Whenever you see price move in reversing, whatever, it's not caused because of order blocks, guys. It's not caused because order blocks was there, a lot of orders, whatever. No, you will notice that it will pretty much most of the time, it will only use imbalances to move from. That's what the price will do. And you will notice it pretty much everywhere on the chart, right? Example here, this particular example. Let's try to explain ourselves here. Why did the price move higher? If we were to only implement the concept of imbalance, there you go. That was an imbalance. That entire thing there is an imbalance. It tapped in towards an imbalance and delivered higher. What made this imbalance strong though? That we need to understand. First things first, if we were to mark our market structure, how will it look like? There you go. External structures, right? Nice, everything good. What do you have here? These external structures, they act as external liquidity, right? There you go. Liquidity there, external liquidity gets taken. Let's put this thing here. Objectives, liquidity, good. Price has taken the liquidity. We have imbalance, good. That is nice. Now, second, the third thing here is efficiency. You have your efficiency sitting at this point. You notice where the price reversed from, guys. Once it has completed three of the objectives, it has taken first the liquidity, second the imbalance, third the efficiency, then only we had some move towards the upside. Same thing again with this push here towards the upside. From where? If you were to mark your market structure here and try to understand the liquidity, how will it look like? Something like this, right? That pretty much at this high here, we created some sort of multiple structures, and then we pushed lower. This low here induced all of those liquidity till where did it stop? You want to mark that efficiency, you want to mark that entire imbalance. Look, there you go. It completed. Once it completed three of the objectives, then only the price moved. Try to explain price in this way, guys, that you know what, pretty much you will notice that it will tend to react from an imbalance that has these three objectives, pretty much these three of the objectives. Another example here, we had some sort of push towards the downside. Why is that? Try to explain to yourself. Sure, to the left, we did have some sort of imbalance. What made this imbalance strong? First, let's mark the market structures. Let's understand the liquidity. You'll notice here that price pretty much pushed lower here, and looking at this bit, we took an external liquidity, good. Price tapped in towards this imbalance here, good. You will ask yourself here, but then where's the efficient? If price is already efficiently bearish or efficiently bullish, it doesn't have to tap in towards an efficiency, guys. Do keep in mind here, we were efficiently bearish, yeah? Over at this bit here, price was efficiently bearish. Completed the first objective here being the liquidity, second imbalance, price was efficiently bearish. That's what it took, and then pushed the price lower. Now you might think that, Jason, that's not a significant move. No, that is a significant move. We're on the 1 hour time frame. We are trying to scalp. Like, we're not trying to predict what the price is gonna do, like for the next 2 decades, right? All we care about is what the price is gonna do for the next hour, 2 hours, 3 hours. That entire move there was 1 day and 22 hours of move. It gave 49, 50 pips of move. I think that is definitely more than enough for us to scalp our way out. That entire move there, that was like a move of 85 pips, 1 day and 8 hours of bullish price. You see, like all of this here, you will notice that the price is reacting off of an imbalance that is being supported by the other two objectives. So let's look at another example here. First things first, okay? Let's look at this high. Where's this high coming from? Let's just check to the left. Looking to the left here. No, actually this current high, whatever we're coming from here, this current high. If you notice, we are rejecting from somewhere, right? What are we rejecting off of? Price here, it took some sort of major inducement. It took that. And then you look all the way to the left. Let's look all the way here to the left. It's an imbalance. It's an imbalance that had like efficient price within that price there. That had an efficient price pretty much, right? Now we tapped in towards this bit here and also tapped in towards this imbalance. We're going to mark the entire thing here as an imbalance. There you go. That's where we're coming from. Or this high here first, previously, that's where it came from. And now, can we potentially reuse that point of interest, same point of interest? The answer is absolutely yes. We can still reuse that point of interest until the imbalance is fully closed, okay? It's just that we need to know till where, if the price were to react, till where, which like should the price react towards. Now, if from this high here, we're expecting some sort of bearishness, you want to ask yourself, till where is it valid to be bearish? You want to look at the bullish price action here, like the bullish price leg. You want to notice, you want to look at the structures. If you were to look at the structures here, pretty much that's what we did, something like that, and then delivered there, broke the high. You know what, this happened as well, and then this. So pretty much that bit there is our efficiency. You will notice one thing here, guys, that efficiency that I'm marking, those are external efficiencies. They're forming within an external structures. So now, technically speaking, if the price were to make a pullback, that is a good imbalance to react off, right? Now you guys might ask like, but there is no liquidity forming or there's no structure forming. Sure, once the price breaks the high there, that will be a structure, right? That will act as a liquidity, can push towards the downside and towards there. If it completes 3 of the objectives, good, we can have proper expansion. If no, then we will most likely push lower. And there is more to it, right? There is more concept about price delivery and that. But still, this is a basic understanding of imbalances. Even though like within this price here, you have multiple imbalances. These imbalances here shouldn't matter at all, guys. Like this imbalance here, the small one, not because it's small. Look, guys, size doesn't matter, man. Let me tell you guys this. This is the definition here. The size don't matter. Let me tell you guys this, right, as well. That when it comes to imbalances, it's not that, it's because small imbalance, so it's not going to work. Nah, it doesn't matter how small or how big it is, right? What matters the most is pretty much these 3 of the objectives. They need to be completed. If you look at these, like that's pretty much the imbalance there. Good. Imbalance worth marking, okay? This imbalance here, worth marking. That imbalance there, worth marking. This one, worth marking. So all of these pretty much is worth marking. Let's look at this one here. Same example. If we had this huge imbalance here, do we just mark it like this? No. What I would do is pretty much wait for that efficiency to be tapped, which means that this is the efficiency that matters the most. Did the price make it pull back towards there? Not necessarily, but again, that also is not my kind move, okay? Same thing here. Let's look at this one here. Where did the price react off? Why did it ignore this imbalance? We had this imbalance. We had this imbalance. Why did the price ignore that? Why did it react off of there instead? Because again, to the left, if you were to mark your structure, how will it look like? Something like this, right? And then we break the low. So there you go. That is your efficiency. Next to the efficiency, what do you have? You have an imbalance. Good. Push the price lower. Okay. It pretty much is everywhere, guys. Pretty much everywhere. Let's look at this here. Same example. Do we have efficiency? Not necessarily, but do we have liquidity and imbalance? Yes. Let's look at this one. What did the price do here? It took a significant, that's a significant liquidity. It took that. Below it, we have an imbalance. Good. Push the price higher, right? Pretty much what I'm trying to say here is, what I'm trying to quote is, an imbalance on its own is pretty much nothing. It's nothing. Like it's just going to be a distraction. You have this entire imbalance here. Let's say an example. You have what to do when you have multiple imbalances like this. Do you mark them individually like this? No. What I tend to do is, first thought process, mark the entire thing. But then, that's too huge though, right? Pretty much that is the one. That is the efficient. There you go. That's the imbalance that matters. All of that imbalance that is above there, those are just noise. Okay, that is the imbalance that matters the most. Now, same thing here. You guys might say, but then Jason eventually it failed. Yes, but that's for future, guys. Like that move there, that is enough for us to scalp. That is like 2 days of move, 2 days and 21 hours of move, 53 pips of move. Definitely tradable for us. You will notice this pretty much everywhere. Same example here. I can't even stop with these examples because it's pretty much everywhere. Look at this bit, right? Within this price here, you had this imbalance, okay? This imbalance here was still left open. Look at that. What did the price do? Mitigating towards an efficiency, it took external liquidity, pushed higher. Now, same thing. You guys think that, but then it eventually broke it. Yes, good enough for us to scalp. That is 8 hours of bullish move. Good enough for us to scalp. Same example here. We had some sort of imbalance. Don't ask me why is it an imbalance. This is the candle formation. Why did it re-ranked off of that? Price was already efficient. It took external liquidity, tapped in towards an imbalance, pushed higher. Okay, that's how you wanna look at things. When you start looking at price that way, right? Now you're not gonna be marking every single imbalances and just expect a reaction off of those imbalances, guys. Right? Because it wouldn't make a lot of sense. Now you have like a lot of imbalances marked. You have shit ton of noise. Which one to focus on? Which one to focus on, and which one not to focus on? Here, implement this thing here. And as usual, guys, one thing do I guarantee a profitability? No. What do I guarantee? I guarantee a change in perspective. Okay. And to me, as a coach, perspective comes first. Thought process always comes first, right? But yeah, guys, hope you guys learned something new. And as usual, please, guys, trade safely. Okay. Don't go insane. And yeah, take it easy. I'll see you guys in the next one.